Hi, everyone. Welcome to Your Money Matters. Ted, welcome back. Hope you enjoyed your vacation. And Clint, good to see you again. I am Angela Giroux, your host and publisher of the Bauman Letter. And of course, at the forefront of all of our minds is this volatility that we just can't seem to shake since the beginning of the year. And this is a good reminder for those of you watching. If you haven't yet seen Ted's 2021 Peak Profit Summit, now is the time. It's coming offline tonight at midnight. There is a link below, and it gives you some great ideas to really sort of minimize the risk in these kind of conditions and at the same time, maximize your gains. So make sure you check it out and make sure you check it out right away. Now, speaking of this volatility, it's a great reminder that, now is not the time for investors to just chase returns. It's a better idea to try and find risk-adjusted returns. And well, that doesn't necessarily mean giving up on the growth stocks, the tech stocks. It does mean having a better strategy, again, of finding these risk-adjusted returns. So Clint, let's take a look at this current environment that we're in. Can we start there?
Yeah, sure. I mean, anytime you talk about risk-adjusted returns, I think, people's minds immediately go to the more boring sectors where maybe the gains are more limited, but that's not necessarily the case because, what we've seen this year, when you talk about volatility, it's been in more the small cap space and some of the growth sectors or renewable sectors, and things that did really well last year have struggled this year. But, you probably lose sight of the fact that the S&P is still up almost 14% year to date. So, I mean, that's still a really solid double-digit return. But when you look at the leaders will probably surprise you. We know we've had this rotation, the more cyclical value areas of the market. We've discussed that before. Sectors like energy and financials are doing well. But in the number 3 spot are REITs, so real estate investment trusts. Kind of get a reputation for being, more boring, a good source of risk-adjusted returns, but they're also up there as well. So here's a chart year to date of the S&P is the blue line, up about 14%. Once again, the red line is IYR, which is a real estate ETF, a broad real estate ETF, and it's up about 25% year to date. So one of the top performing sectors we've seen this year. I got another chart I want to show just to visualize sort of this big turn in relative performance that we've seen out of the REIT sector. So this goes back a year, and this is a ratio now. So this is a ratio of IYR, that real estate ETF, relative to the S&P 500. So when this line is falling, that means the S&P is doing better, is outpacing IYR, and vice versa when the line is rising. So over the past year, we had this situation to about the start of the year where REITs continued to underperform the market. It doesn't mean they were down, but they were underperforming what the market was doing, the broader market was doing at that point. But since the turn of the year, you see this pattern, this line just turn around very sharply. And what I'm highlighting on here with the green line, this was sort of kind of a chart breakout level to keep an eye on. And just within the last couple of weeks, we've seen a strong breakout over that level that signals to me that we're going to keep seeing this REIT outperformance. And this one more chart here, this comes at a time when we're focusing on the short term, but the big picture, the longer term, we're seeing a very major breakout underway with REITs. So here's this next chart. This is IYR again, but this is a monthly candlestick chart going back all the way to 2000. So if you look at the left-hand side of the chart, you see the first big run up and then drawdown. That was going into the 2008 financial crisis. We had the recovery after that. We got back to those prior highs, and then you had the pandemic set in. But now look at where we are. So that was major resistance that we have now just recently taken out in these last 2 months or so. So, both the short-term and the long-term picture is looking really good for REITs right here.
Now, Ted, I know you're a huge fan of REITs, and rightfully so. Our endless income portfolio is comprised of a ton of REITs, and it's absolutely crushing the market right now, and our subscribers are just collecting these massive yields. But I know there's another reason that you are particularly fond of REITs right now, if you could share that with our viewers.
Yeah, well, I mean, look, first of all, just to clarify, I mean, REITs are a subset of the real estate sector, but they are a really great way to invest in real estate because you don't have to do anything. Basically, what's happening is you're getting the benefits of owning real estate, and you're getting the return, from rentals and all the other things that come with it, and you're not having to do it yourself. And so when we talk about real estate, it's really important to remember that REITs are a way to participate in that without all the hassle, and that's one of the main attractions. But right now, for me, the big attraction is that REITs are earning cash money right now. In other words, they're bringing in income, they're bringing in free cash flow, they're paying out dividends. And I think what's happening is we're seeing a rotation away from future returns, which is growth stocks. People willing to bid up the prices of companies that may or may not generate, big returns 5-10 years from now, the Teslas and so on, versus companies that are earning money right now. And in an environment where people are starting to think about possible inflation and interest rate hikes, then that shifts people's attention to the value of money right now. Money in the future becomes worth less because of potential inflation. So money right now is worth a lot. And so what's happening is you're seeing a lot of big institutional investors moving back towards REITs. And there's a good reason historically why. Let's look at a first chart that shows 20-year annualized returns by asset class. This is from 1999 to 2019. And if you look at the S&P 500, it's actually, kind of far back. The biggest one, the annualized return, is REITs, 11.6% annualized return. That's both stock price appreciation and dividend yields. So, there's a 20-year history right up until very recently that shows that this is the single best asset class to own over the long term. It's just as simple as that. Next chart shows why that's the case. And this shows that REITs are resilient right through the business cycle. Even when you're moving out of recession, especially when you're moving out of recession, REITs tend to far outperform the market, almost doubling the market. In the middle of a economic cycle, they underperform a little bit, but then in the late cycle, they outperform the market again. And in a recession, they tend to do at least worse than the market as a whole. So that's the thing, that REITs are resilient across the whole cycle, and that's because they are consistent generators of cash. And when things are not good in the market, that's what investors want. They want cash. They don't want the speculative potential of maybe a company producing a great product 5 years from now, 10 years from now, flying taxis and all that. They want income now. So here's a chart that also shows exactly what that translates into in terms of earnings. The blue line on this chart shows basically the year-on-year growth in funds from operations, which is the term we use for REITs. It's not the same as EPS, but it's comparable. And you can see, just by eyeballing the chart, you can see that the fluctuation in the earnings of REITs is far less than that of the market as a whole. On the right-hand side, you can see that the standard deviation, in other words, the average differentiation from the norm, is only about 10% for REITs as opposed to 16% for the market as a whole. So what's happening here is that as things become less certain, we're starting to talk about a regime shift possibly in the Federal Reserve. We know that they're looking for an exit strategy for backstopping the market. We know that people are worried about overheating in the economy, although personally, I don't see that as a big long-term risk. Nevertheless, what's happening is that investors are starting to say, hey, I'd like some certainty in my portfolio right now. And that's precisely why our endless income portfolio is basically doubling the market this year, and doing far better than the growth stocks, the ones that were better last year. Here's a final chart that shows the intentions, if you like, of various investors, big money investors, of where they think they're probably going to put their money going forward. Now, in the past, it was all about equity, very little focus on real assets like real estate back in 2000, somewhat more in 2018. But look at the projections. I mean, essentially, the expectation is that as we wind out of this long multi-decade bull market in equities and we get more normal returns to the market, you're going to see investors shifting their attention to fixed assets like real estate, precisely because they want that income. And so the projection is that by the end of this decade, 60% of their money will be in those kinds of things. Now, that means that if you get a jump on it now, you can be part of the run-up in price that comes when money shifts to a new sector like real estate. So that's why I'm bullish on it. And we've just picked up a couple of great REITs that are delivering excellent yields and are growing those yields quickly. it's money in the pocket now, not maybe later.
Well, just something to also mention really quick on that last chart you're showing. I think one of the reasons too that the institutional crowd is starting to shift more into real asset type areas like REITs. You talked about sort of returns for stocks normalizing. Well, yeah, I mean, because of where valuations are at, actually the projections that a lot of people follow from GMO, another asset management firm, shows that the next several years could be a difficult stretch for the market. So here's their most recent return projections. Now this is per year over the next 7 years. So when you look on the first column on here, this is U.S. large cap stocks. They expect U.S. large cap stocks to go on to return almost -8%, once again, per year for the next 7 years. And that's just simply a reflection of where valuations are today in the markets. We need that mean reversion to basically bring things back down to normal. And so when you get sort of that longer term potential for drawdowns in the market, that's where dividends really come in. I got just one more chart I want to show to illustrate this point. This comes from JP Morgan. If you look at the top panel in this chart, this shows by decade the source of return for the S&P 500, how much came from capital appreciation versus how much came from dividends. And we know, the 2010s that, we've just most recently going through was a great decade for stocks. You got a lot of return from capital appreciation, so from prices going up, and a little bit from dividends. But when you get into these longer term bear markets, most recently, like the period from 2000 to the 08-09 crisis, I mean, stocks didn't go anywhere. You can see on here, the only source of return you had came from dividends. And same thing in the 1970s. You look at the 1970s, that was another just lower to sideways market over a long period of time. And you see that dividends were the main source of your return. And then just in the bottom panel of this chart, highlighting that, the top areas that you can look for generating income for dividends, global REITs, right there among the top 4 spots. So, the top, no one rings about the top. Once the top is here and you're in that bear market, if you haven't done anything to prepare, it's probably going to be too late. So it's a good thing now to just, you don't have to change everything right away in your portfolio, but just start chipping away at some of the gains, take some of the profits that you have and start to build up this income piece, because sooner or later, we're going to hit this difficult market stretch. It's just a matter of not if, but when.
Yeah. And don't forget that if you reinvest the dividends you get from these things, if you don't need the income now, you can, set yourself up for geometric gains, just basically that get bigger and bigger as time goes by. So that's an important piece too.
Yeah, and as a reminder for Bauman Letter subscribers, as Ted mentioned, he'll be releasing a new recommendation, a new REIT. You'll receive that in your inbox on Monday, your monthly report. So be on the lookout for that. And if you are not a subscriber, it's a great time to join. Now, Ted, I have one last question for you here, because obviously when you talk about REITs, there's so many different types. Mm-hmm. Would you have any sort of recommendations of what you might want to avoid or what you might want to take a closer look at?
Well, I mean, first of all, REITs, they can own anything,
Right.
I think, people tend to associate them with things like malls and retail, but that's only part of it. I think right now, there isn't a lot of opportunity left in the more specialized REITs like data centers and those technological REITs, simply because their prices have been bid up a lot. They pulled back a little bit, but not enough really to justify, putting money into things like data centers, which are obviously important to the economy. But they don't pay very high yields because they tend to spend a lot of money on expansion. Right now, the big value is actually in that retail sector. And a lot of the retail and also hospitality REITs have been beaten down. A lot of them are still trading at, 10 or 15, in some cases, even, 20 or 30% below previous highs. And not all of those REITs are going to fail. In fact, most of them won't. Most of them will bounce back. So I'd be looking at the boring stuff. I'd be looking at companies that own malls that everybody thinks are going to fail. They're going to repurpose those things. They're going to find ways to rotate that capital that they have invested in those things into other types of assets. Smart companies that have been run well over many years will not just go down with the ship with malls. So I think if you buy some of those companies that own these retail sites now, they're going to, like I said, they're going to rotate into new assets that'll generate higher returns. They're not just going to sit and do nothing. And if you can grab them now at a discount, you set yourself up for really good gains going forward.
All right, well, thank you. And as a reminder to those viewing, if you have any comments, if you agree, disagree even, we'd love to hear from you. So please drop those comments below.
Yeah, just do us a favor. But before you click dislike on the video, watch it first. I noticed some people like to click dislike before we even play.
It's an amazing thing. There must be psychic.
All right.
All right. Thanks so much, Ted and Clint. I'll speak with you next week.